Hello everyone and welcome back to the channel, your go-to source for understanding the complex world of market mechanics. Today, we're diving deep into a fascinating corner of the market, hard-to-borrow stocks and the potential for a short squeeze. We'll be using a specific real-world example that recently hit our screener, RYOJ Company Limited, ticker symbol RYOJ. This isn't a recommendation, but a fantastic case study to illustrate how these dynamics play out. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, let's talk about RYOJ. RYOJ Company Limited operates in the industrial sector, specifically within consulting services. This Japanese company provides labor and corporate consulting, alongside health services. Currently, RYOJ has a modest market cap of $45.07 million. Looking at recent price action, RYOJ is down 5.71% today and has seen an 8.76% decline over the last 5 trading days. However, zoom out to the last 30 days, and the stock is still up a substantial 27.74%. Today's trading volume has been quite low at just 10,300 shares, a stark contrast to its 30-day average volume of 444,870 shares. That means its relative volume today is practically 0 times its average, indicating very little current trading interest. Show chart, RYOJ price and volume. What is cost to borrow and why it matters? Now let's break down a critical concept, the cost to borrow or CTB. When a short seller wants to bet against a stock, they first need to borrow shares from a broker. The CTB is the annualized fee they pay for the privilege of holding those borrowed shares. Think of it like interest on a loan, but for stocks. When a stock is in high demand to be shorted, or shares available to lend become scarce, this fee can skyrocket, often exceeding 100% annually. Yes, you heard that right, over 100%. Why does it matter? A high CTB indicates that there's significant short interest, or that shares are incredibly difficult to find for borrowing, or both. It puts a constant pressure point on short sellers, as the cost of doing business compounds daily. Why this stock is hard to borrow right now? This brings us back to RYOJ. According to our latest data, RYOJ has an astonishing annualized cost to borrow fee of 567.1%. That's an extreme number that immediately flags it on our hard to borrow screener. While the CTB momentum shows a decrease of 41 percentage points over the last 5 trading days, meaning the fee has dropped slightly from an even higher level, it still stands at an extraordinarily high rate. What's driving this? A critical factor is the incredibly limited supply of shares currently available to borrow, a mere 3,000 shares. When you compare that to RYOJ's estimated float of 2.3 million shares, you can see how tight the supply-demand picture is for short sellers. Our internal composite squeeze score for RYOJ currently sits at 42.4 out of 100, reflecting this blend of high CTB, low borrow supply, and other factors. Squeeze mechanics explained. So, what does it mean when a stock like RYOJ is hard to borrow with such a high CTB? It sets the stage for what's known as a short squeeze. Imagine short sellers are betting the stock will fall. If, for any reason, the stock price starts to rise, these short sellers begin to lose money. To limit their losses, or if they're forced out by margin calls, they have to cover their short positions. Covering means buying back the shares they initially borrowed. Now, if there are very few shares available to borrow, like only 3,000 for RYOJ, and the cost to hold a short position is sky-high 567.1% annualized, any upward price movement can trigger a scramble. Short sellers are forced to buy back shares in the open market, creating demand, which pushes the price even higher. This creates a feedback loop. Rising prices force more shorts to cover, which pushes prices further up, trapping even more shorts. This can be especially potent in a stock with a relatively small float like RYOJ's 2.3 million shares, as it doesn't take a huge amount of buying to move the price significantly. However, it's crucial to understand that a high CTB does not guarantee a squeeze. It can also signify that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to maintain their positions. Dilution risk check. Before getting too excited about squeeze potential, we always run a dilution risk check. Dilution occurs when a company issues new shares, which increases the total share count and can depress the stock price. This provides an easy exit for short sellers and can entirely negate the short squeeze thesis, even if the cost to borrow is sky high. For RYOJ, we found no recent dilutive SEC filings such as -1, -3, or 424B forms in the last 90 days. Furthermore, there have been no recent reverse splits, which can sometimes precede dilution or impact share structure. This absence of immediate dilution risk is a positive factor for any potential short squeeze thesis on RYOJ. Again, a quick reminder, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For RYOJ, if you're tracking these dynamics, here's what to keep an eye on. Firstly, continue monitoring that extreme cost to borrow rate. While it recently dipped, any sustained increase or continued pressure above 500% is significant. Secondly, the number of shares available to borrow, currently just 3,000, is absolutely critical. Any further decrease could dramatically intensify the squeeze potential. Thirdly, volume. RYOJ's current volume is extremely low compared to its average. For a squeeze to ignite, you typically need to see an increase in buying pressure and volume. Remember, while RYOJ has been up over the last 30 days, its recent performance over the last 5 days and today has been negative. An increase in price on higher volume would be a key indicator to watch. So, there you have it, RYOJ Bubble Company Limited presents a fascinating case study in the world of hard-to-borrow stocks. With an eye-popping 567.1% cost to borrow and a mere 3,000 shares available to short, the conditions for short squeeze mechanics are technically present. However, it's not a guarantee, especially with its currently low volume and recent price weakness. It's a powerful illustration of the forces at play when short interest is high and borrowable shares are scarce. We hope this deep dive into RYOJ has been educational and helped clarify what makes a stock hard to borrow and the potential for a short squeeze. If you found this video insightful, please hit that like button, subscribe for more content like this, and let us know your thoughts or any questions in the comments below. We love hearing from you. Thanks for watching, and we'll see you in the next video.